Come on. Yo, GM everyone. Welcome back to Phase Live. Very, very exciting guest we've got on today. We've got Luke from Loopscale joining us. So I think this is going to be a pretty good one. Luke, what's going on, brother? How you doing?
Good. Good to see you. Thanks for having me on.
Oh, sorry. I lost you for a second now.
Can you hear me okay now?
Yeah. I think it was your mic picking up some movement in the background there or something. All good though. What's happening, man? You looks like you've been out in the wind there today. I was just admiring your hair before we hopped into the stream.
Yeah, a little jogging to the office earlier. Hair's a little bit chaotic. How about you? How's everything going?
Very I keep hearing like a lot of noise from your microphone, it seems. I'm not sure if you're using your laptop mic or
Here. How about now?
Way better. Way better. Thanks.
Easy. All right. Well, yeah. And how's it going with you? Everything good on your end?
Yeah, all good my end, man. Been a busy day, but an exciting day. Excited to dive in shortly. But before we get into that, obviously a quick introduction to my awesome co-host, Gotto. Gotto, what's happening, brother? How are you doing today?
GM, dude, I'm amazing. Yeah, it's been a good day so far. Dude, stoked for this one. We had a recent activation with Loopscale, and it's been awesome working with you guys. So yeah, stoked to finally chat.
Yes, definitely. It's been fun. Where do you want to start?
So I think let's start by maybe you could just give us some context and a quick introduction to yourself, Luke. Maybe just tell the viewers who you are, how you kind of fit in at Loopscale, how long you've been there, and a little bit about your background in the space.
Sure. Yeah. So one of the co-founders of Loopscale. We've been around Solana now for almost 5 years, sort of just building and working on different things. Initially really interested in kind of the intersection of how, Solana Rails and all the cool stuff DeFi can build. Ultimately might end up help powering some of the changes to the normal financial system that everyone's been so kind of excited about as it relates to crypto's kind of next step. Making things a little bit more efficient or composable or secure or whatever it may be. So we've had a few different iterations of the business around that kind of core thesis of using DeFi plumbing to kind of fix TradFi Rails. That sort of has led us to where we are now with Loopscale and kind of building a more novel approach to DeFi credit and ultimately, autonomous credit generally. So yeah, definitely happy to get into the weeds on it, but that's the high level.
Awesome, man. Sounds good. And tell us a little bit more about how you got into crypto in the first place. Go back to the beginning. Give us a little bit more of a deep dive on who Luke is.
Yeah, well, so my background is in engineering and economics. So I was a trader right out of school. Had a lot of fun just kind of working on, algorithms and different ways to approach kind of like the more efficiency side of markets and thinking about those types of problems. And so when DeFi Summer 2020 popped off, it was a lot of fun to kind of take some of that interest and convert it into something that was, maybe a little bit more short-term profitable. There's a lot of cool things happening, and it was really interesting to learn about. So I remember, sitting at home, listening to some of the A16Z, crypto school podcasts. And at the time I was living in Chicago, and there was a decent bit of Solana kind of ecosystem happening there at the time, and then moved out to New York, where just tons of crypto activity, especially in 2020, 2021. And so lots of cool meetups, stuff like that. And just you kind of get slowly, roped into the different cool things that are going on, always excited about the next thing. And it's just really exciting thinking about all the ways that, the kind of pillars of the existing financial system really have been built on a, more like Frankenstein together kind of modernization over the last 50 to 75 years of technological progress, and thinking about how to rip out a lot of that stuff and start from scratch is really appealing. So sort of a gradual build in interest, but I'm a very hands-on DeFi user, so definitely would say that was kind of the biggest hook for me.
Awesome. Okay, great. Yeah, that's a nice backstory there. Now, tell us a little bit more about Loopscale itself. Maybe you can explain the product itself to us as if we were like just getting into crypto. What is Loopscale at its most fundamental level?
So Loopscale is a lending product. So if you have a bunch of crypto assets and you don't want to sell them to pay taxes on them, or you don't want to necessarily give up the upside, whatever it may be, you can use Loopscale to kind of pull out some of that equity, similar to what you might do with like your house, or a business where you can pull out some of that liquidity short term, pay a small interest rate on that, use it to do whatever you want, and then when you come back and repay it, you get your whatever asset you owned originally back. And then kind of on the other side of the equation, since Loopscale is a peer-to-peer lending platform, if you have cash sitting around not doing anything, it's a great place. Park it, earn 5 to 10% on your idle cash, and have it all secured by sort of these very over collateralized loans, where the assets that borrowers are putting up are worth a lot more than the assets that they're pulling out. So at its basic level, it's a financial concept that I think pretty much plays a role in everybody's lives day to day, whether it's credit cards or mortgages or any of these more business lending type products that exist outside of crypto, just brought to both a more modern kind of set of assets. So obviously crypto is one option, but we also have a lot of interesting RWA or off-chain assets that we support as well. Primarily things like obviously all the big tokenized assets, but we've even done a number of products with things like whiskey, collectibles, trading cards, things like that. And then things like private stock. So if you own, small number of shares in some company that's not public yet, it's much harder to get liquidity on that. But we can build markets around that as well. So there's a lot of interesting things, a lot of interesting markets that don't really exist outside of the context of what we service, but that still nonetheless need liquidity. And so, we're working very hard to kind of expand the addressable options for folks who want to participate.
That's super interesting. I'm curious to hear, I mean, it's a little bit of a digression here, but a little bit curious to hear your take on RWAs, because obviously, it's interesting. This is something that a friend of mine 2-3 years ago, he was talking about it, and he's like, RWAs are going to be like this huge thing in like 2-3 years from now. And I was like, bro, like, what are you even talking about? Like, I don't even understand, like, how is something that's off chain supposed to be on chain? Like, I don't get it. What is your kind of, I mean, obviously now that they've kind of exploded, whether it's with collectibles or, different other arenas in the RWA space, what is your kind of take on RWAs, and do you think that they're just going to continue growing over the coming years?
Yeah, well, I think you kind of have to separate it out into a couple categories. So like the one that's really taken off lately, right, has been this like tokenized, credit fund or like stock type product. So like Prime is a good example of that. ONYC, even Syrup USDC to some extent. These are all assets that are basically, off chain funds that have shares tokenized that are put on chain, and when you buy this token, you kind of have some like exposure to the underlying investment vehicle, whatever that may be. And those have really seen a lot of traction, primarily as like a sink for stablecoins, as stablecoins have continued to kind of grow in their adoption, whether that's via payments or just people exiting trades and wanting to keep it on chain just for the ease of use and ability to repurchase crypto later more easily. You just see that as like a very good or a very interesting option for where those stable coins can go, especially over the last year, as kind of on-chain borrowing from like a more native crypto perspective has really slowed down. So I think there's definitely going to continue being demand for that stuff as stablecoins continue to become more important. If more and more payment rails move on chain, you're going to have these assets sitting on chain saying, hey, what do I do with all these stablecoins? And RWAs are a great kind of a counter-cyclical option for investing those stablecoins that don't necessarily require you to have a very deep understanding of crypto and any of the kind of more weird assets that might end up existing in some of these lending pools and things like that. So it's interesting for that reason. There's lots of cool mechanical things that we could touch on with that, but some of the other stuff you mentioned, collectibles, for example, we think of that kind of as more like the end origination piece. So like, whereas with something like Prime, you're basically investing in a fund for somebody else to go originate loans, right? In the case of like a collectibles lending product, the people who actually own the asset and want to take out the individual loan are coming to you directly to do that piece. That piece is much more valuable long-term for crypto to be able to service, whether that's with collectibles or eventually things like homes or business, shares in businesses, whatever. And so we're much more interested kind of over time in expanding our support for that type of lending product. But it still is very small relative to, sort of these big sync type RWA products that are a little bit more like off-chain managed, on-chain capital sourced.
100%. Yeah, that definitely makes sense. Okay, so maybe next we can talk a little bit about APY, because obviously with a lot of loops or things people can do on your platform, they can obviously get quite significant juicy APY. Can you walk us through how exactly that works and how people are able to get such good APY from these loops or LP farming or staking? And obviously there's so many different types, but yeah.
Yeah, right. Well, and so this answer won't cover everything, but I think the kind of the main one, especially this relevant for Phase launch that we did 2-3 weeks ago, is kind of this concept of a carry trade, which is basically saying I own some collateral asset that has an intrinsic yield to it. So by holding this asset, I'm earning X%, and there's somebody willing to lend me a very similar asset that's not yielding anything, but for just under X%. So maybe they're, you're holding treasury bills and earning 4%, and somebody will give you dollars separately if it's secured by treasury bills for 3.5%. And so some of these very high APY numbers are specifically due to the fact that there's lenders who are taking a different position on that collateral asset. The lender's coming in and saying, hey, I don't really want to hold this asset. I'm okay with having a little bit of indirect exposure. If the thing goes down in value, whatever, I'm protected via LTVs and liquidations. And I have more access to kind of instant liquidity to withdraw my capital from these lending pools. So I'm willing to accept a lower rate. And then on the other side, you have people who say, I understand this collateral asset really well. I'm willing to, take extra exposure to that and, as such, be compensated and build up kind of like that spread across, borrow and lend asset. And so ultimately, you're both taking on the risk of the asset deviating from whatever its expected value is potentially. And then you're also taking the execution risk. So, hey, I'm going to go get this collateral asset. That's going to cost me some money, and I'm going to unwind from that later, and there's probably a fee to unwind it or whatever, depending on what the asset is. And so there's extra costs and management, and you have to be watching the rates and whatever. So it's much more active to manage a loop than it is to manage a lending position. And so as such, you see these big spreads. So if you look at the lending deposits, those are, say, single digits, maybe 5 to 10%, right? But then you look at the looped products and you're getting into the double digits, 20% potentially higher. And that's much more driven by these like very active users who understand how to manage those positions in a profitable way.
100%. Yeah, that makes sense. I'm actually looking at it now on the app, and you can definitely see, I mean, you've got basically like 10 times the APY with a lot of the looping products that you guys have on offer. All right, cool. And then obviously, I think kind of getting into that topic, I think it would be really cool to explore our recent kind of partnership with Yield, which is just launched. I'd love to kind of give you the opportunity to speak a little bit more about that. And Gatto, if you want to chip in as well, you're more than welcome to.
So yeah, I guess, sorry, what would be the best place to start on that? Like, are you familiar generally with what's gone on?
I mean, if you could just explain a little bit more about the kind of partnership and speak to what exactly Yield is and how it works, or Gatto, if you would prefer to take it, you're welcome to.
Yeah, 100%. Yield is our Phase stake LST at Phase. And so Yield's APY comes from obviously stake, but also a part of Phase's business revenue. And so you're getting a boosted APY. And then obviously on top of that, when you're looping it in Yield, you're getting an APY there. I think right now, sorry, I'm just trying to get there. Yeah, I mean, average APY right now is 37.56%, which is awesome.
Yeah, that's juicy.
I don't know if we lost him.
Maybe.
Yeah. So, I mean, ultimately, like, the going back to kind of how I was framing the looping product, right? You have Yield, which is yielding, a little bit extra on top of what a normal LST is yielding due to some of the rewards mechanics you guys have built in. It's then borrowing SOL from mostly the SOL Genesis vault on Loopscale, but really any lender could lend against Yield. And then providing kind of the ability for people who want to own Yield and contribute to the Phase ecosystem, purchase it, et cetera, to then kind of increase that exposure, via the borrowing. So we've seen pretty good uptake on that so far already. There's obviously, with kind of the chaos that's gone on in DeFi in the last couple of weeks, it's definitely been a little bit of a push and pull on different things. So, we're really excited to see kind of the growth on Yield specifically as things smooth out and people kind of move into a little bit more of a growth phase generally in DeFi deployments.
Absolutely. Yeah, for sure. I think that would be a good segue to kind of maybe, only if you're open to it, ask your thoughts on the drift exploit and kind of see like how you guys have like positioned yourself from a security and audit standpoint to just make sure that something like that doesn't happen to you.
I mean, Loopscale was like one of the platforms that wasn't affected at all, right? Out of a lot of platforms that were affected. So
exactly.
Yeah, I mean, I think they obviously it's is very tough thing, and TBD still on some of this Tether kind of saving stuff. So hopefully, everybody ends up getting made as close to whole as possible on that very tough situation. The way that we've kind of thought about the security stuff, we've had a sort of a lot of things that we've over time added to both the protocol and kind of the OPSEC stack that we've done to make sure that we have both as much real-time visibility into what's going on with the protocol, with users, with the health of the platform in general, as well as kind of a lot of fail safes. And so we've had lots of external audits, and then also it's sort of something that has been now ingrained with us is just concept of like living security. So like every day, everything we're doing, is constantly with a flare of security as a part of that. So like the, development of program stuff, obviously, but everything in the, API stack, all of the different like, partners that we're onboarding, anything that we're integrating, people we're working with, even for small things like marketing, whatever. It's very, important to us to make sure that that's like security first with that stuff, and try to make it a habit with just kind of the questions you're asking and the things that you're doing. Obviously there's no like fully bulletproof verified way to never get, hacked or scammed or, have some, weird OPSEC thing go wrong. But at least from what we've learned from some of the really, well-experienced folks in the security space here, asymmetric guys, SEAL team, et cetera, they're all very, clear about, security being a sort of a core ongoing practice rather than hey, I'm going to get audited, pay $100,000 and call it a day. And so, we just try to make that as much of a focus for everybody with everything that we build and do and people we talk to, et cetera.
Awesome. Yeah, that's great, man. Good to hear. And obviously, like you said, there's no 100% guaranteed way to be perfectly safe. Like there's always risks. I mean, even with the drift hack, I'm sure that they had like a lot of measures in place to avoid something like that happening. And just the sheer scale of that attack was insane. Like, absolutely insane. Like, I mean, it's not like one person or a small team of people. We're talking like a massive kind of group of people. So definitely pretty gnarly. And thoughts and prayers go out to them. Hopefully they can bounce back much stronger from that. All right. Let's talk a little bit. Let's go back to kind of talking more about like Loopscale itself. What would you say makes Loopscale different from traditional lending protocols and your standard yield aggregators?
Yeah. So the kind of most important thing is that we've sort of rebuilt the like kind of core, what you'd call, the logic for how you determine, what a rate, is going to end up being, what collateral is going to be accepted, how capital gets allocated to different loans, et cetera. And instead of the way that the vast majority of DeFi works right now is everybody puts money into a pot. That pot can be drawn on by anybody who comes in and matches some set of criteria for collateral. And then based on, these people borrowing at different quantities for however long they want, the rates sort of will fluctuate based on how much is used at any point in time. Loopscale kind of like ignores like this entire concept of like, these pools and kind of having this very rigid construct of like what makes up a viable lending pool. And rather everything is treated much more like you would treat like going to a bank to get a loan. So it's like every individual loan is determined at the time of loan creation. Terms are all snapshotted. So it's kind of like, you and the lender, if you're the borrower, you and the lender are kind of coming to an agreement saying, hey, I'm going to pay X%. Here's the collateral I want to use. Here's the terms, like different ways that if something goes wrong, here's like what we're going to do about it. All of the different, like, hey, if at expiry, this is what happens. Here's how like a rollover would work. All the different like things that go into making up a loan, all of that can be codified at the moment of loan start. Effectively, like that's the core building block for the rest of the platform. And so the stuff that the end user, on loopscale.com is seeing doesn't necessarily like immediately reflect that. But think of it more like the like Lego blocks that build up this much more vibrant machine that is the Loopscale protocol, Loopscale app. Ultimately allowing us to offer much more interesting lending products. So against some of those like weirder collateral assets, more, bespoke lending products. If a firm needs a longer duration loan, they're not really interested in having kind of exposure to other assets on the platform. They just want to be doing their one thing. Easy for us to set something like that up. And then lots around kind of like the integratability and ability to like set rates based on a number of criteria, whether it's like who the borrower is, what combination of collateral they're using, what LTV they want to end up using, the duration for which that they're borrowing, et cetera. All those different things can kind of be used to price the loan. And so it's not only, improves the user experience on like kind of an individual today DeFi user way, but it also expands much better to the variety of lending use cases. As I mentioned, mortgages, credit cards, corporate debt, whatever it may be. All of these things run on sort of more bespoke rails than sort of, hey, we're just going to apply one line math equation to decide everybody's terms on everything, in perpetuity. And so that's sort of the inspiration for it is like, first principles, how do you think about building a, automated lending product? And the automation doesn't necessarily happen at the, determination of terms. The automation happens at the execution of terms. So everything is like, codified into the, loan at point of sale. And then everything end to end from there is automated. But in terms of building a market around this, it's much more active. It's more of like a trading experience or a bank or a credit fund where you're underwriting people, collateral, underwriting the risk of an individual loan, duration risk, et cetera. And so short term, there's liquidity issues. It takes time to build that up, takes time to onboard people to use that, but you can offer much, much better products across the board with that. And so basically our job right now is kind of expanding the, serviceable market for that and bringing people in on both sides of the equation that benefit from that immediately and can help kind of build that liquidity up so that smaller, more casual users also can start to see the benefits.
Exactly. Yeah, that definitely makes sense. And I think that's a great explanation and definitely separates you guys from competitors and stuff. Okay, and then moving on, how do you guys manage collateralization and liquidation risk and rate dynamics?
Well, lots of different things. So like, I guess, starting with some of the like parameterization stuff, so like LTVs, things like that. So those are all determined on a per lender basis. So you could go right now to Loopscale and set your own, hey, I want to lend against, yield at a 99% LTV because it's a staked asset and I feel good about it, whatever. So you could go in and do all that stuff. The main way that we kind of try to make that easier for folks is through our Vaults product. Vaults product is basically, having somebody else setting those parameters and then you opting into those parameters. And so we kind of have, for the vaults that we help curate, we have a kind of set of criteria around, the different sort of tiers of assets. And based on those tiers relative to the principal, the borrowed asset. So like LST versus SOL is like kind of a good example of like that safest tier where you have a very, very heavily audited smart contract with, a lot of really interesting, issued assets that use that. That's something that could have really high LTVs. If you go to, for example, go to the SOL Genesis one there at the bottom, and then scroll down on this to the, keep scrolling here a little bit, the parameters. So you can see here, so if you just search like search yield or something, you can kind of see at any point in time, if you lend to this vault, one thing that it could be lent, your SOL could be lent to is folks borrowing against their yield. And they can get, in this case, up to 90% LTV,
Right.
which even could be higher. And you see it with other assets that, like on Jupiter, I think they'll let you borrow against Jupe SOL at like a 95% LTV or something like that. And ultimately, for something like staked tokens, the main risk is a vulnerability in the staking contract, which is used by just about everything. So it's ultimately not necessarily as big of an issue for LSTs. the other issue you have is sort of for a borrower is sort of the duration risk and the yield risk effectively. But yeah, so it's basically on a per asset basis. We're underwriting it, determining kind of the overall risk associated with that asset relative to the asset you're borrowing, and then from there, kind of fit it into an existing box of LTVs, liquidation ratios, and then rates. And then rates in vaults are generally driven by allocation. So if a lot of capital is being used on one specific asset, we'll push up rates on that a bit to kind of keep things somewhat towards a target allocation or a maxed allocation across things to not have too much concentration. And yeah, I don't know if you had any questions on that, or to move on to some of the other kind of risk related things you mentioned.
We can move on to maybe like liquidation risk.
Yeah, sure. Well, so I guess by liquidation risk, are you talking kind of more like the risks to borrowers, like how liquidations?
Yeah, exactly.
Yeah, so liquidations on Loopscale are semi-competitive in that they're auction-based, but they are not fully open. So whitelisted liquidators are the only ones who can participate in liquidations. But basically, the way that that works is you have some asset that you're borrowing, some asset used as collateral. As value of collateral goes down or value of debt goes up, there's some level. We call it the liquidation threshold, but LQT, whatever that once you hit, we'll have to seize some collateral and then sell that and then repay some of that debt to kind of bring you back to a more healthy level. So it's all partial liquidation. So if you're borrowing, $1,000, you get liquidated. It might only need to sell $500 worth of collateral, repay $500 worth of debt. Now you have $500 borrowed versus some smaller amount of collateral, whatever it may be. But your main risk in this flow for like an LST, like yield, is that you're sitting in a loan for a long time. The borrow rate could move up over time, right? If yields are tight or whatever, and then if the yield of yield starts going down, then you might have a situation in which you're paying more than you're earning on your yield, and so the value of your debt might be growing faster than the value of your collateral. And if you do that for long enough, right, you might end up at a spot where now you've breached your limit. That being said, for something like yield, it would be very hard. It would take a very, very long time to do that, or the borrow rate would have to be really, really high. Just because the assets are pegged to each other, so and generally the yield is like very similar. So it would let's say like for yield, we just looked at yield on the market there. It was showing the LTV is 90% and the liquidation ratio was 95%. That would mean that the value of the debt would need to grow 5%, and the value of the collateral would need to not move in order for that to be able to be liquidated at all. Which ultimately means that you would have to be like say earning 5% less for a year for that level to be hit. So you would have to have the position open for a very long time and at a huge negative to where you started. So for stuff like LSTs, liquidation risk is very unlikely. We've never had to liquidate an LST on the platform. But for more volatile assets, if you're borrowing USDC against your SOL, then it's pretty common to have that stuff happen.
Right. Yeah, that makes sense. Okay, cool. All right. And then obviously I'd say it's safe to say we're going to chat a little bit about market context now. I mean, I think it's safe to say that we've been in a bear market for the last couple of months, maybe since like late 2025. How would you say being in a bear market has affected your guys' operations? Because obviously in a bear market, people are still, lending and borrowing, and maybe stuff is more focused on stable coins. But would you say that like participation has gone down, or would you say that it's kind of remained the same irrespective of market conditions?
Well, it's definitely, I think the total activity has gone down. I think there's like kind of two main themes that we've noticed, like total active addresses, whatever, just like across the chain, especially on DeFi things, is lower. the amount of money that people are moving around is lower. Part of that's just the prices are lower, but also I think, folks have pulled out entirely. The second big thing that's more recent, it kind of started around, say early February, kind of that last leg down, but like, Resolve, the stablecoin got hacked, obviously Drift, the Scalp DAO thing, like the amount of money that's like been leaving Solana, but really DeFi in general, worried about the next potential, North Korea thing, is like pretty significant. And that's been pretty noticeable, especially not even on Loopscale necessarily, but we see it kind of around on other platforms on Solana and elsewhere. And I think that is almost had a bigger impact than, the immediate downturn had, because you just kind of have these like people who were long-standing, like maybe it's balance sheets of bigger companies, whales who've kind of kept their capital in DeFi forever, that are kind of not seeing the premium worth the risk. So it's a little bit of a flywheel, right? Like a lot of the yields in DeFi are driven by the bull market, whether it's basis trading or like people levering up to go long something or trade meme coins or like whatever it is. And so if there's not a lot of that activity, then yields on the lending side are low, and then if yields on the lending side are low and there's this hack risk, people are like, wow, what am I doing? Why would I put my capital in something like this? So it's it's going to take time for that to work back into the system. Probably yields are going to have to move up, activity is going to have to move up, and so it's all very reflexive. And as the market improves, I would expect a lot of that to sort of rewind or undo itself. But for now, it's sort of a we basically have two lines of thought with this. One is, hey, we're going to go tackle like the markets that are here in DeFi right now, what users are currently here, like how can we better serve them? And then the second one is, how can we use the Loopscale kind of core product to service maybe borrowers and lenders, users outside of DeFi directly, and sort of have Loopscale or the crypto component of this just be one leg of the journey, and some other pieces that are not necessarily so dependent on a bear or a bull market.
100%. Yeah, that definitely makes sense. All right. And what would you say is next for Loopscale in terms of roadmap, new strategies or assets? What have you guys got coming up? Is there anything you can share in the next couple of months or weeks that people can expect from you guys?
Yeah, I mean, definitely some stuff that I would love to share, probably shouldn't yet. But we do have some really cool assets coming up that are both some bridged ones. So some of these probably folks will have heard of, some not, some new RWA stuff. So some of the like, Stretch and some new credit funds with some pretty cool partners that will be interesting to see. There's also, a bucket of new assets that's sort of like a little bit smaller teams, maybe on ETH or RWAs that are looking to grow those assets. And we love to be able to use Loopscale as sort of like a vehicle for kind of exposure on those things. And then also growth kind of the underlying, how do you take it from, 5 million of deposits to 20 million? Like, we would love to be able to help kind of scale those things up. So we will have a number of new vaults, new collateral assets, loops coming over the next month or so. And then some pretty major updates to the product. So kind of thinking into the middle of the summer, we'll have kind of the next major, version of that. We'll be going live with some big partners, and I'm excited to be able to push that out and hopefully include yield in some of that stuff as well.
Absolutely, man. Okay, cool. Gotto, any last questions that you'd like to ask Luke before we wrap up?
No, I don't think so.
Cool. All right. No worries. Well, Luke, any kind of closing thoughts that you'd like to share, or anything you'd like to share before we call it a day?
No, I really appreciate you having me on. It was great to chat, and looking forward to continuing working together on some of these things.
Absolutely, man. Yeah, thanks so much for making the time today. And also big shout out to everyone in the audience who tuned in today. We appreciate you guys. We'll see you back here as always, same time, same place next week. And yeah, thanks again, Luke. Take care.
Yep. See ya.
Awesome.
Later,
Cheers, guys. Peace.